Thanks for joining us today on Market Call. I'm Morella Fernandez. Brianne Gardner with us on the show. She's Portfolio Manager, Senior Wealth Manager at Velocity Investment Partners, Raymond James. She'll take your questions today on Canadian and U.S. large caps. Here is how to reach us today. 1-855-326-6266. If you want to call in, you can send your questions in an email as well. BNN Market Call at bnnbloomberg.ca. Brianne, good to see you. Thanks for joining us today. GDP numbers coming in for Canada stronger than expected. What does that tell you?
Yeah, I think everyone, especially Canadians, are watching the economic data very closely and approaching year end. You know, we almost went into a recession in Canada in the last 2 quarters. Really, to confirm a technical recession, we need 2 negative quarters of GDP growth. And we're just, last quarter, we did just beat that as well. So, are we starting to turn around from a Canadian perspective? I think time will tell. And we never really know we're in a recession until it's later on down the road. But we have seen, Bank of Canada, I think, do a good job of diverging from the U.S. and making those cuts that our country needed from a path of rate cutting. So for us, that was the right decision they did to, I think, help us to potentially even avoid a recession in Canada.
Okay, household spending is down. More cautious consumers like more cautious investors?
Yeah, I think we've seen growth overall has cooled, inflation easing, sentiment, swinging in every data release. So even though investors are shifting from outcomes to preparing for a range of scenarios, we are looking at, yes, spending, consumer spending headed into Black Friday, Cyber Monday, and also year-end holidays. It's still remaining steady, but I think people are looking for those discounts, and they're going to be pivoting a little bit of their spending habits leading into those holidays. So we are going to be watching spending closely. Earnings have remained resilient out of companies. We have seen policy support. So for us overall, we are remaining a little bit cautiously optimistic about the road ahead. And I think in the U.S., attention is really moving from interest rates to what matters for 2025 and how that positioning works. So the quality and durability of earnings is still strong and really carrying the market solely right now. And I think a big part of the conversation we're seeing is the growing scrutiny around revenue circularity, and especially in the AI, that has been flown around quite a bit. And I think this discipline is healthy, though. So for us, yes, customer expansion, diversified revenue, and improving margins are all things we are going to be watching for from an economic standpoint and profitability standpoint.
Okay, so you mentioned getting ready sort of for various scenarios. You're looking at diversifying as a way to do that. Where are you seeing money going into that perhaps it wasn't going into before?
Yeah, I think if we're looking at a straight valuation standpoint, we're starting to see a little bit of a pickup in the healthcare sector. If we think of where healthcare was at the beginning of the year, even mid-year to where it is now, looking at PE ratios specifically, have started to see the healthcare pick up. Materials, we expect to still be strong and continue to be strong through the end of 2025 into 2026, especially, gold, silver, precious metals. And AI, we don't see is going anywhere. Yes, even with some sell-offs in some of the bigger names, looking at Microsoft and Meta, we still think that the momentum is going to carry. So for us, again, we are looking at Canada's path forward, U.S. and international from a geographic standpoint, but rate cutting cycle is still continuing, which is positive momentum for the equity market. We are seeing, there's still a lot of cash on the sidelines that will be coming back into the market at some times. The extreme greed index is still more on the extreme fear side. So for us, that telling us, investors are a little cautious right now, which could be a great buying opportunity for people with cash on the sidelines. And I think headed into the new year, our view on portfolio positioning does remain consistent, kind of maintaining that neutral equity allocation, avoiding some of those zombie companies that aren't really doing much and staying stagnant, and lean on quality specifically in those companies. And any volatility we do see and are expecting would be an opportunity to high grade your holdings in the position. So taking profits, maybe cutting some losers, and rotating into good quality companies with strong profitability at the end of the day. So I think we have a good couple years ahead based on a few factors, and we are optimistic headed into 2026.
All right, we're going to take a quick break. We will be back with Brianne Gardner of Velocity Investment Partners, Raymond James. She's taking your questions today on Canadian and U.S. large caps. Back in a moment. Welcome back, and thanks for joining us on Market Call. Brianne Gardner is our guest today, and she's here to answer your questions. The first one comes in an email from Rob. He says, is Race a buy? Race, of course, is Ferrari. Brianne will pull up the chart in just a moment. But what's your take on sort of the high-end luxury auto sector right now?
Yeah, I mean, I think you're seeing from a consumer spending perspective, the high end still spending on luxury goods, and the lower end or middle consumer starting to reduce their spending and looking at more discounting. Obviously, you can see Ferrari, an extremely volatile stock, not one that we do own, but we do have exposure to the consumer discretionary space, again, through more of those staples like Dollarama and Amazon in our main positioning. I think the thing is, we know that wealthy shoppers don't really slow down their spending in a recession as their income tends to be more consistent. We've seen that in many luxury brands, even thinking of LMVH. For us, we're more defensively positioned in our portfolios, and while an economic downturn won't likely stop a Ferrari buyer at the end of the day, if the stock market rolls over, there could be a couple weak quarters for the company. So for me, that said, I think analysts have been pretty dialed on this one. The stock has hit targets prices at least a dozen times over the last 5 years. And yes, it's down from its February peak, but Ferrari has a consensus buy rating from analysts on the street. So they see an average price target of around $420. So that's a significant upside from where we are today. So again, not a stock that we own. I think a little too volatile for us, too niche of a market, but analysts definitely still see upside from here.
Okay, that is good for the email. Let's go to JC on the line in North Bay, Ontario. He's got a question today. Hi, JC.
Hi, I'd like to ask about CES Energy. You've liked it in the past. I had some of this sold recently as it kind of moved up back past my entry, and now it's gone a little bit higher. Do you think it's still a hold here or a rebuy? Thank you.
Okay, thank you for the question. Can you tell me a little bit about the company?
Yeah, I mean, they engage in kind of the provision of consumable chemical solutions. So through a life cycle of oil fields, they do including drilling, fluids, production chemicals, transportation, logistics, kind of full company, founded back in 1986, headquarters actually in Calgary, Canada, which is great. We still like the stock. I think price upside, as he mentioned, we have seen a nice run up in the stock even this year alone. And we still like it. It fundamentally ranks a 9 out of 10 for us. I mean, year to date up about 22.8%. From a value perspective, though, with this run up, we'd see about a 7 to 8% upside still from here. So not a huge, but we still, again, are bullish on the stock. I mean, analysts on the street looking at buy to outperform, no real holds or underperform. So that is positive to see as well. And again, you're not getting a huge dividend from this stock at all. I think you're getting like 1.5 dividend yield, but fundamentally still a great quality company.
Okay, at 12.32 today and up almost 30% on the year. So that was for JC. Let's go back to an email from Nancy. She says, hi, it looks like TVE shares are going up. In your opinion, is it a good idea to buy some more shares? We'll pull up the line chart for TVE. This is Tamarack Valley. And energy space in general, are you sort of looking more towards that way because of the AI build out?
Yeah, I mean, this isn't a stock actually that I'm not as familiar with. In the oil and gas exploration space, pretty volatile stock, but is certainly fast growing, kind of in that small cap Canadian oil producer. You've seen certainly even from that chart there, you can see, recent strong momentum, but it does still remain sensitive to oil prices and operational risks. So the stock's, up, I believe, around 65% year to date, is driven by the production, the growth, and cost discipline that I'm seeing, which analysts have generally praised. And it has mostly positive outlook. So, not horrible. We do not own this, but the energy exposure we have is through a little bit more larger cap, CNQ, ENB, for example. That said, general consensus on this stock is a target of about over $8. So, single digit upside from here potential. Also, the stock has never actually hit analyst targets, something that we do look at in the past 5 years. So it might be priced for perfection right now. They recently raised the dividend and posted some strong earnings growth. But if you already own the shares, I'd say consider trimming into the strength and adding in on dips. But for new buyers, we'd wait for a pullback or at least some consolidation to see kind of some sideways movement.
And typically when you say wait for a pullback, what kind of pullback are you looking for?
Yeah, I mean, I think it is sector specific. So, energy usually tends to be a lot more volatile than, say, consumer discretion or consumer staples that usually are consistent. So for us, I would say energy, again, very tightly ingrained to oil prices. So if oil prices are fluctuating around, you likely will see a lot of these energy companies move too. So we aren't surprised to see even a 10% pullback in energy is normal volatility to see in a stock, whereas, a 10% pullback in some large cap names would be a big opportunity for investors. So I would say, even if you could get the stock to pull 10 to 15% back, would be a favorable entry point for consumers.
Got it. All right. We're going to take a quick break. Brianne Gardner of Velocity Investment Partners with us today. She's taking your questions on Canadian and U.S. large caps. Back in a moment. Welcome back to Market Call. We have Ray on the line in Pickering, Ontario. He's got a question today for Brianne Gardner. Hi, Ray.
Oh, hello. Happy Friday. Brianne, I'm preparing to purchase a stock for my tax-free savings account next year, and I've been watching Fairfax Financial. I was just wondering if this checks all the boxes you mentioned at the start of the show with, good quality management and profitability.
Okay, thank you for the question, Ray. Brianne, Fairfax today at 24.02. It did trend down a little bit, sort of at the end of August, maybe right at the beginning of November, and trending back up since then. What's your take on Fairfax?
Yeah, Fairfax, is a great Canadian company. Value score ranks at 8 out of 10 for us. Fundamentally, a 9 out of 10. Best known for really their property and casualty insurance business, but also a major investor in a wide range of companies. We don't own it in the portfolio, but certainly our firm covers it, and we're seeing even from here potentially upside of about 20% on the stock. So the Fairfax shares are up about 22% year to date, have delivered over 20% returns over the last year, outperforming most of their insurance peers. Stock trades at a reasonable PE, 8.4 times. So for us, that's opportunity there. And analysts currently see it undervalued by as much as 65% compared to its intrinsic value. So it might be a stock that we actually add to our watch list there. The business model, I think, is a mix. You're still getting insurance is the space that we like and see a lot of opportunity right now. And I think they are known for taking bold bets, sometimes out of favor sectors or companies, which can lead to some big wins or occasional misses. But the company has been expanding and making some strategic portfolio moves. So risk, I would say, is that their results can be a bit mixed because of their investment style, but their returns, I think, have been good. So it is a unique business overall. More like a mini, almost Berkshire Hathaway than a traditional bank or insurer, I see it as. So I'd say it's a solid pick for an investor who wants exposure to that sector in a little bit more of a contrarian way.
Okay, good to know. Let's go on to Rob, who's in Calgary, with a question. Hi, Rob.
Hi, thanks for taking my call. Happy Black Friday. I'd like to hear Brianne's opinion on Algonquin Power. It's been trading in a range for a while, and I'd like to know if she sees a catalyst for a breakout, and if she buy, sell, or hold the stock, or if you would prefer another player in this space. Thanks again, and have a good weekend.
Thanks very much. Algonquin Power in renewables. Tell me about whether you see a breakout for the company. I think it's currently trading at $8.58 is what I have. Let's pull up that chart and double check that. Brianne, what's your take on this company?
Yeah, we don't own Algonquin in the portfolio. Has had some struggle recently in the utility space. I think the company is still in the middle of almost a multi-year turnaround, though. I think they have had a little bit of a tougher period with higher interest rates or higher interest costs and slower execution. They do still, though, run a mix of regulated utilities across U.S. and Canada, which means most of their earnings come from stable electricity, which is positive to see and rewarding for a company to have that stability in them. Electricity, gas, water operations, the company is working to really simplify their business. They continue moving away from some of those riskier segments and focusing more on regulated utilities where we could see more cash flows are steadier and easier to forecast. So for Algonquin, I remain a little bit cautious. The balance sheet is improving, though, but leverage and past execution issues really keep us selective here, especially when other utilities offer, I'd say, some cleaner stories or stronger visibility in that space. For us, we own Brookfield Infrastructure. I know Rob was asking for some other ones there. Capital Power and Hydro One are just a few that we own in the space instead of Algonquin.
Okay, I hope that helps him make a decision. Let's go on to Elliot in Hamilton, Ontario. He's got a question today. Hi, Elliot.
Good afternoon. Please, I think I see a lot of value to be unearthed in this merger between Capital One and Discover. What do you think? And would you start a position at 120? Thank you.
Thank you for that question. Would you start a position where it's at today?
We don't own Capital One again. I do think it's a strong player, though, in kind of that credit card, digital banking. But I do prefer JP Morgan, for example, or for broader exposure to the U.S. financials. I mean, fundamentally, Capital One scores an 8 out of 10, but from a value score, about a 4 out of 10 for us. Analysts still expectations about potential upside of about 20% from here. So, you are seeing quite strong on the buy and outperform across the board. Again, not a stock I own. We have our exposure to financials a different way. But if I was looking at getting in this stock, it wouldn't be a bad time. You have had some volatility recently on the year to date, especially, but it hasn't had a huge breakout yet, especially for the financials. So they've been tightening, I think, underwriting and building reserves early, which has helped them manage through a slower consumer environment. I think the demand still remains healthy. Card spending is holding up. And I think Capital One's really digital deposits continue to grow, especially among higher income households. So long-term setup is positive, I see.
Okay. And I should say it's at about 220, 219 right now. I think I said 120 just a moment ago. That was for Elliot in Hamilton. Let's go to Bill in Sarnia with a question. Hi, Bill.
Yes, good afternoon, and thank you so much for taking my call. My question's on Aritzia. ATZ, and I'd just like to know what you think of the recent rise in its value and where it might go from here. And could I get a possible consensus too, please? And I'll hang up and listen to your answer. Thank you.
Sure, I'll see if I can find the consensus. Quick question, sort of sub-question to this is, we're headed into that key period where all of the retailers expect to make a lot of money, and some of them count on making the money. As we mentioned, Black Friday today, the holiday season, that kind of thing. But it feels like a slower time for consumers. We had the GDP numbers come in, household spending is down. We know there are still concerns for North American consumers. If these retailers don't sort of hit that mark, there could be some trouble ahead for them. What is your take on Aritzia?
Yeah, I'd say even in the consumer discretionary space, we have been a little bit underweight with concerns of consumer spending overall. We don't own the stock. We have in the past, though. It's definitely still a strong Canadian brand, even if, I owned and have traded Lululemon again. We don't own that stock too, but even the outperformance of Aritzia versus Lululemon, Aritzia has been a clear leader, but the company is still working through, I see, a rebranding phase after, a tougher stretch in the U.S. market. They have been focusing more on those premium everyday apparel and running a vertical integration model. So for me, I see it as giving it control over design, pricing, margin. So that's a big advantage in the retail space. Their demand is stabilizing, which is positive. U.S. tariff or traffic trends have improved, which is good for their U.S. business, and new stores that they've launched have continued to perform well, helping almost rebuild their momentum after last year's slowdown. So I think their growth plan has remained intact, and they are continuing to open more boutiques, refreshing key brands, and improving their e-commerce experience to continue to drive more growth over the next few years. So financially, the company's recovering, margins are improving, their inventories are normalizing. I still think that overall, fundamentally, the company is still strong and solid, ranks a 9 out of 10, but from a value score, it's actually 1 out of 10 for us. Your analysts on the street still rank it a buy and outperform, but from a price target and how much upside I see from here, I would actually expect to see a pullback in this stock in the short term.
Interesting. Okay, good to know. Let's take a quick break. When we come back, we'll take a look at Brianne's past picks. That's coming up next. Time now to go through past picks from Brianne Gardner from March 19th of this year. Brianne, at the time you chose Meta Platforms, so Meta on the NASDAQ. And at that time, here's what it was priced at, $584.06 US. So it's moved up to $642.76 today, a 10% upside for return and total return. Do you still hold Meta? Have you trimmed it all moving forward?
We still own Meta. I'm still bullish on Meta. Even with the sell-off, I think it's a great opportunity for investors who might not own Meta to get in. We use this recent dip as a chance actually to add it fully for some of our newer clients that had some cash. So again, you don't always see huge sell-offs like this. And I see it still holding a long-term trend there. So it looks like it had bottomed, and we use that as an opportunity there. I think it still deserves a long-term spot in portfolios. We've seen their ad engine remain strong, advertising spending more now because Meta continues to deliver some of the best conversion results in the industry. So Reels have become a major growth driver, now generating over $50 billion a year, showing how quickly Meta can scale into new formats. I think we've also, I've seen Meta is leaning aggressively into the AI as well. CapEx measures margins today, but historically these big investment cycles have paid off. And with Threads already at 105 million daily users and WhatsApp ads now coming next year. We're seeing new revenue streams are lining up for Meta, which will be positive for their bottom line. That $16 billion tax charge, that was a one-time hit from the One Beautiful Bill. That's why we saw that sell-off. I see that as an accounting adjustment, not necessarily a sign of weaker profitability, and the underlying fundamentals still remain solid. So I see about over 30% upside here for the stock, and it ranks a 9 out of 10 fundamentally for us.
Okay, I do want to ask you about the CapEx for AI, because they're spending a lot of money, and people have the same lingering concerns from the metaverse spending, right, where there's a lot of spending and not a lot to show for it in the end. But do you feel comfortable with it?
Yeah, I think the one thing that we are watching, and I believe will be unfold through to 2026, will be the CapEx is surging, and I think we're seeing that primarily led by a handful of those large tech companies, right? Amazon, Microsoft, including Meta and Google. But these companies are investing, yes, hundreds of billions of dollars annually into the data centers, their chips, the GPUs, servers, networking, all of that. So we are forecasting, what is that going to look like through 2026, 2027? And I think the one thing we are going to start tracking now is going to be, even though there's a concentrated group of hyperscaler accounts for this bulk of spending, what is going to be their ROI, right? So certainly these companies are continuing to beat, just saw it from NVIDIA as well, year over year. Their expectations are, they're going to do double-digit growth, but, is it going to be the rate of return that they're hoping by getting this spending? So I honestly think it's a little bit of a wait and see, and time will tell.
Okay, let's move on to your next pick, which is Costco, COST, on the NASDAQ, very well-known name, a company that is expanding at 904.05 when you picked it in March, and again, that's U.S., now to 908.77, so 1% upside here, total return also at 1%. Is this a company you remain invested in? And with consumers sort of worried about inflation and tariffs, all that kind of thing, do you feel there's growth here for Costco?
Yeah, I think the stock has pulled back from its February highs, but I still really like Costco, the company, the business model, everything, and it's done well for us over the years. It has some support at this level, right? Even where it's trending, and it's still up almost double from a couple years ago. So fundamentally, shoppers stay with Costco. They are loyal because they get real value. The renewal rates are close to 90% for memberships, which is showing that exceptional loyalty there. And Costco is still gaining momentum. Sales are growing faster than even Walmart and Target. They've added over 4 million new paying members last year alone. Their digital commerce is finally becoming a real contributor after slowing a year ago. So we saw now their online sales bounce back up 26% jump in September. So we see this growth story remaining intact. The increase to fees is boosting high margin, and Costco plans about 30 new stores this year, including strong international expansion. So we still see double-digit upside from Costco from here, almost 20%. And fundamentally, Costco ranks a 10 out of 10. So I think it's going to be a great stock headed into 2026.
Okay, let's move on to your last pick then. Eli Lilly, LLY, on the New York Stock Exchange. Pretty well-known company. It was 837.01 U.S. at the start of the year when a lot of things were beaten down. It's moved up to 1,078.38, return of 29%, total return of 29%. There's some steam here, I believe, for this company. That's what I'm hearing from people. Do you think it's going to have a better run in 2026 than it did this year?
Yeah, I mean, as you can see, has had a nice rally up recently. Again, a lot of people, even through the summer, were, as we continued to hold Eli Lilly, were questioning, the healthcare sector and space. And then we've started, looking at adding at those times, and we really saw the takeoff there. So Lilly is hitting all-time highs, and with that recent pop, becoming the first pharmaceutical company actually to hit $1 trillion market cap. So it is our at our original target price now, but we're reevaluating a new target price. So some things see another potentially 50% from here because the company has become one of the strongest growth stories in the healthcare space, really led by their breakthrough in that weight loss and diabetes medicine, and demand is incredible. So the treatments are reshaping how patients almost manage weight and their metabolic health, and Lilly is one of the few companies that have been able to keep up with the surge of prescriptions. So the company is building out new facilities, and really I see is this exciting runway for them. Analysts now expect the weight loss drug market to surpass $100 billion, and Lilly is positioned to capture a meaningful share of this. So we don't think the story ends there. They have late-stage opportunity also in the Alzheimer's and oncology that could really add entirely new layers for long-term growth. So we are potentially looking at taking some profits off the table here, but we continue to own Eli Lilly in the portfolio.
Okay. Let's take a quick break, then we will get back to your phone calls and your emails for Brianne Gardner when we come back. Stay tuned. Welcome back to Market Call. Let's go right back to the phone lines. Joe is in Montreal. He's got a question today for Brianne Gardner. Hi, Joe.
Hi. I want to ask Brianne about Telus. I'm retired, and I have Telus in my TFSA. It's about 15% of my holdings, and unfortunately, it's down almost 30%. I see some analysts say that they recommend holding on to it, good dividend and such. Another one just saying there'll be no growth for the next few years. I'd like Brianna's advice on whether I should hold on to this, my TFSA, or dump it, and what she would suggest in its place. Thank you.
Thank you for the question, Joe. There has been discussion, Brianne, as you know, about whether or not they can sustain the dividend. They pay a decent dividend. What is your take on the dividend and just telecommunications, but Telus specifically?
Yeah, I think Telus is in our portfolio. We've traded it a few times over the last couple of years. It's been a challenging performer recently. I think the stock's down year to date, and over the past 12 months, I do see people are a little bit nervous, as you mentioned, about the dividend being possibly cut. Right now it offers a 9% dividend yield, which, seems high. Those are like energy prices you're getting, or energy dividends you're getting for, a stable consumer, stable business there. So, or the utilities. So I think for us, the business is stable, but growth has slowed as competition is intensifying. So there's ongoing pressure on cash flow, meaning the dividend could be at risk if the condition worsens. So Telus continues to really invest in their digital health. They're aiming at diversifying revenue. I see improving long-term growth prospects. So I'm remaining cautious on that small weight. So right now, value 9 out of 10. For 50% in a TFSA, I would say that's a heavy weight, but I would ride it out and continue to hold.
Okay. Good advice there. Let's go to William in Kingston, Ontario. He's got a question today. Hi, William.
Hi there. Thank you for taking my call. My question's on Canadian natural resources. I know it's very strongly correlated to the price of oil. It's CNQ's in a very tight trading range. Would you be stepping in at this point? I'd be interested to hear your remarks.
Okay.
Thank you.
Thank you for the question. I know, Brianne, in sort of the AI build-out, all energy sources are going to be pulled on. That's my understanding. CNQ has been kind of going more sideways than anything else. The price of oil is part of that. Would you put money in today? It's at $47.32.
Yeah, since the April kind of pullback, we have started to see an uptrend in the stock. Yes, it's been slow, but I see that uptrend continuing. We do own CNQ in the portfolio, still one of Canada's largest oil and natural gas producers. I think they're focusing on that low cost production and operational efficiency. So they have a balance sheet that is strong. I like the dividend over 5%, and management has a track record of increasing payouts. So the company benefits from scale, integration, allowing them to really weather the market cycles better than any peers. So with the commodity prices volatile, as you mentioned, it's always a risk, but I think that they have the cost discipline and financial strength to make them a core holding among energy stocks. So yes, I would be adding or buying into CNQ at these levels. Value ranks a 9 out of 10 and fundamentally an 8 out of 10 for us.
Okay, we're going to have to leave this block right now. We'll be back with Brianne Gardner of Velocity Investment Partners. She's taking your questions today on Canadian and U.S. large caps. We're back in a moment. Welcome back. We are going to Peter on the line in Calgary. He's got a question today for Brianne Gardner. Hi, Peter. Peter, are you there? Okay, let's see if we skip by Peter and move on to Bill in Bowmanville, Ontario with a question. Hi, Bill.
Thank you for taking my call. I'd like Brianne's thoughts on Alta Gas. Does she own it? Would it's a good stock for TFSA? And any yes would be appreciated. Thank you.
Thank you for the question. We'll pull up the line chart for Alta Gas in just a moment. Brianne, what do you say?
Yeah, we don't own Alta Gas. Great, again, in that utilities midstream company, steady cash flow from the natural gas distribution and the energy infrastructure asset. So the utility segment provides that stability. We're seeing still that side that adds growth through export and storage, but both parts of their business still move with natural gas. Has been trending upwards and had a nice return year to date. I believe we're up about 30%, currently trading at around that $43 per share. For us, we prefer utilities that we own, Hydro One or Brookfield, I mentioned before, and Capital Power, because even though they can have some commodity exposure, their cash flows, balance sheet, and long-term contract structures give us better visibility. So again, I don't own Alta Gas, but I still see value. It ranks at 8 out of 10, fundamentally a 7 out of 10. So not a bad score there. Analysts are expecting price target upside of about 8 to 10%. You're seeing mix between buy and outperform, a few in the hold and underperform. So for me, if I was looking at adding to a tax-free savings account for more upside growth, I would wait for a little bit more, maybe a 5% pullback before entering a position.
All right, that was for Bill in Bowmanville. Let's go to Amin in Ottawa. Hi, Amin.
Hi. My question for the young and upcoming lady is for Element Couche-Tard. The stock is not going anywhere, so should I buy more?
Okay, thank you for the question. Couche-Tard did report earnings. They've been going a little bit sort of sideways, I guess, since the 7-Eleven attempt for acquisition that didn't produce anything. What's your forward take on a company like Couche-Tard, which still has plans to acquire and move forward that way?
Yeah, thanks, Amin, and thanks for the kind compliment. Couche-Tard, 13% upside from here, I see, based on even street target analysts, convenience store, gas station. I certainly see that starting to pick up, even if there is risks of consumer spending slowing. Those discounted lower price items like convenience store goods will continue to do well. That's a resilient business model with everyday consumer demand. So I believe that their scale and operational efficiencies help maintain their steady margins, but the recent performance has been a little bit mixed. It's been trending sideways for a year now if I'm looking at the stock, and the company continues to invest in store upgrades and digital initiatives to drive that growth. Pay a modest dividend, nothing special, but the real value I see is coming from the ability to generate cash and reinvest in growth. So I still remain constructive on long term, and it ranks a 9 out of 10 for us from a fundamental score.
Okay, that is good to know. Do we have time for one more email here before we have to go to a break? We don't. Okay, so we do have to leave it there for phone calls and emails. We thank you for calling in and sending those questions in. But when we come back, Brianne will share some new top picks. Stay tuned. Join us on Monday for Market Call. Michael Hakes will be with us on the show. He's Senior Portfolio Manager at Murray Wealth Group. He'll take your questions on U.S. and global stocks. And if you missed Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Let's get to new top picks from Brianne Gardner. Her first one is Constellation Energy, CEG, on the NASDAQ. Is this a green energy company, basically? I know they do nuclear, but they do wind as well. And what do you like about it?
Yeah, they are the largest producer of clean power in the U.S., supplying about 10% of America's carbon-free electricity to more than 16 million customers. We added Constellation Energy during the April tariff sell-off, and it has quickly become, I see, one of the strongest contributors also to our portfolios. So the stability of the business really stands out to me, even when power markets get volatile. Constellation's nuclear plants runs with very high reliability, giving its earnings visibility most producers cannot match. So growth is accelerating. The company has signed 2 major power deals with data centers, more than any other operator, and it expects at least 1 more agreement soon. So the long-term outlook is strong. Demand for always-on electricity keeps rising, and Constellation is guiding to double-digit earnings growth through 2030. So we still see double-digit upside from here, price target of around 405, and fundamentally it ranks an 8 out of 10 for us.
Okay, let's get to your next pick, which is Microsoft, MSFT on the NASDAQ. Quick question about Microsoft. How long do you think you've held it? And what do you see about Microsoft from the Mag 7 that you like this over some of the others?
Yeah, Microsoft we have owned for years, traded also quite a bit, but has been one of our best long-term holdings. And this short-term breather, I think, is just an opportunity to get all clients to full weights for us. So anyone who is underweight or newer clients with cash on the sidelines or who have given us cash, we're using this as an opportunity to add to Microsoft position. So we see it as the remaining heartbeat of the enterprise cloud AI that is driving the next leg of growth. I think their new partnership that they are doing, expanding Microsoft's AI ecosystem, reducing their dependence on any single model provider, which can help them to support long-term innovation and flexibility. Obviously, their purchase $30 billion of compute on Azure, giving Microsoft stronger visibility in that cloud demand and ramping up their workload. We're not as worried about circularity here that we've talked about, and I see them as still a leader in the space. So the growth is broad, not as concentrated as some of the other tech names. The runway is still early, and I think most industries are just beginning to deploy their AI tools, and Microsoft is positioned to benefit across cloud, productivity, software development, and cybersecurity. So ranks at 10 out of 10 fundamentally for us. And I see actually 30% upside from here from that large cap name.
Wow. Okay. Quick question, because you talked about circularity, and we've seen a lot of these agreements where big tech sort of invested in another big tech, and that's what you mean by circularity. Why are you not worried about it for Microsoft?
Yeah, I think that, if we're looking at some of them, like the OpenAI, the NVIDIA, et cetera, I think their ecosystem that they've built they've made it so they have reduced a dependency on any single model provider. So that is going to help them to support long-term innovation and have that flexibility. I think that's why I'm not as worried there. They have come from thousands of enterprises using the Azure, the Office together, not from a tight, fragile loop like OpenAI, Oracle, and NVIDIA. I think the growth is broad, not as concentrated.
Okay. Let's get to your third pick then. Boston Scientific, BSX on the New York Stock Exchange. They do sort of medical devices, that kind of thing. And you say something about their irregular heartbeat treatment, I guess, is one of the positives for the company moving forward?
Yeah, and again, in the healthcare space, we have seen that continue to do well. Boston Scientific is a fairly recent addition for us. They make less invasive devices for heart issues, chronic pain, exactly where patients' demand is moving. So they're becoming a leader in treating irregular heartbeats, as you mentioned. They're also improving their stroke prevention device for patients with irregular heartbeats, which new versions are coming out. Hospitals are choosing them for a solution. I think this business is financially solid. Strong margins give them room to keep investing in new technologies and support steady long-term growth. With this aging population needing healthcare means, they're going to continue to increase their consumer base. So ranks at 8 out of 10, and I see about 26% upside from here with a price target of about 128.
And is this a company that ships globally or works with global partners?
Yeah, so they are globally. They have worked with global partners and continue to expand into the global markets. So again, I think there is more opportunity for them to continue to do that as well, right? Any opportunity or any space that a healthcare sector can get into, I think that they will continue to do well. But yes, they have kind of been spreading, headquartered in actually out of the States. And yeah, they are growing.
Okay, I just want to circle back to where we started the discussion today. We're getting to the end of the year. Consumers seem to be reining it in a little bit more this year than they have in past years because there are concerns about inflation or job security, that kind of thing. How would you advise investors at this point as we look towards the end of 2025?
Yeah, I think looking towards the end of 2025, I think we still have had quite a bit of muted volatility. We wouldn't be surprised to see a year end or even head into January, so a little bit of a short-term sell-off. But again, I think that is normal and healthy for the market to take a little bit of a breather. The economic data and the buildup from the U.S. government shutdown coming in now, we will see if some of that data comes in a little bit weaker than expected and how that positioning is going to be for 2026. After we see a sharp V-shaped recovery like we saw in April, 2 years later, historically, the markets are bullish. Again, why we believe 2026 is going to be strong.
Do have to leave it there. Brianne Gardner, thank you so much for joining us. Have a good weekend. And thank you for joining us today. We'll see you back here again on Monday.